All right. So we will start the class today with again looking at the, yesterday's document that I have given. So from the list, from here, the previous document that I gave, the economic survey highlights. Yesterday we did CPI and your headline inflation. Can anyone tell me what is headline inflation? What is the meaning of headline inflation?
Total inflation experienced by consumer.
The total inflation experienced by a consumer, meaning all components are used, right? All the components are used. Fine. Then what is CPI? Consumer Price Index. What is CPI? What is Consumer Price Index?
Price paid by the consumer.
Consumer Price Index is what does it do? Consumer Price Index. What does Consumer Price Index do?
So it checks the prices of the final goods that to the final customers so that it can regulate it whether it increases the price or not by the RBI.
Yeah, changes in the retail prices. Okay. And what is the main aim of Consumer Price Index? What is the purpose of Consumer Price Index? What is the purpose of Consumer Price Index? Why do we check Consumer Price Index? Anybody?
Measure inflation faced by common people.
Yeah, to measure inflation, right? To measure inflation faced by common people, all right? And Consumer Price Index and all this index are nothing but a measure of inflation. How do we measure inflation? We have two indexes. One is Consumer Price Index, and what is the other one? What is the
So
other?
also the price index.
Wholesale Price
Or
Index.
wholesale price index.
Okay, Wholesale Price Index. So what is Wholesale Price Index? What is Wholesale Price Index? If Consumer Price Index is the changes in price of retail prices, what is Wholesale Price Index?
So the prices in the production stage.
Yeah, prices in production changes, cost of production, and based on that, when traders or businesses sell their products in bulk, okay, remember that is Wholesale Price Index. It is mostly used by businesses. Consumer Price Index is mostly by consumers. The component is consumer, okay. So these are two type of indexes that are being used in India to measure inflation. Now if you have gone through the Telegram group yesterday, I have given a current affairs, and I was telling in the class also that the government might introduce a new wholesale price index or a different index, okay, the changes in wholesale price index. So if you looked in the Telegram group, there is a current affair that government is trying to change wholesale price index into what? If you have read, what is the new index that is coming soon?
So producer price index.
Producer price index. Okay, so the new index will replace producer wholesale price index after 5 years. okay, after 5 years, because all across the world people use producer price index as a measurement of inflation rather than wholesale price index. We are still following wholesale price index. Now in the news also, if you have read, wholesale price index base year also has been changed for the next 5 years, and after that 5 years wholesale price index will be taken out from the system of measuring inflation. All right, so please keep that in mind. Producer price index is a new index that is coming up. It is very clearly marked in the current affairs that I gave you from the newspaper clipping. I have highlighted all the things, so just read it once, you'll come to know. Okay, it is very clearly marked there, you'll understand it. All right, so keep that in mind. Now we are discussing since yesterday the topic, the concept of inflation based on our economic survey here. So we know that consumer price index and headline inflation is at 1.7%, okay, 1.7%, which has been reduced from 4.6%. all right, that we have discussed. We will also look today the monetary policy. Okay, why monetary policy? It is very important. This one we have done yesterday, the new CPI series, the new consumer price index series. We have already know. We understood yesterday that the base year has been changed from 2011-12 to 23-24. So please keep this in mind. Okay, why this was needed? We knew that because of our people getting higher income, there is urbanization, spending on housing and services, and growth of digital economy made it compulsory to change our base year. All right, so now in the basket of measuring CPI, we have also digital services. All right, fine. So that was, we understood. The major feature was the basket or the weightage of food and beverage has been reduced to 36%, following Engel's law. So keep this in mind. Suddenly APSC might feel like, what is Engel's law? They might ask, all right, from economic perspective. So please keep this in mind. Then housing went up. The weightage of measuring CPI for housing has gone up. Then more weightage has been given to all these sectors. All right, all these sectors. So we understood all this. All right, we understood all this. We also knew what was the significance behind it. Now inflation, impact of inflation, we know negative ones are there, a lot of negative. I am pretty sure that you read this. Okay, if you did not understand, you can still ask now. All right, then positive impacts are there. Inflation is not just only negative, sometimes it can act very positively also. For example, when you have mild inflation, what is mild inflation? What is the other name of mild inflation?
So creeping.
Yeah, creeping inflation. Okay, so creeping inflation rate is how much?
Up to 3%. Sir.
Up to 3%, 0 to 3%. Okay, so please keep that rates also in your mind. Okay, suddenly if you get like, what is the rate of creeping, match the following types also you might get. Okay, so we know this negative and positive impacts of inflation. All right, now in India we have a target of inflation. Okay, how much inflation should we have in India? We have a target, and this target was first suggested by Urjit Patel committee in 2014. Okay, who was Urjit Patel? Anyone knows?
The governor of RBI.
He was governor of RBI. Okay, who is the present governor of RBI? Anyone? Who is the present governor of RBI? So please keep that as in mind, okay, for examination point of view. Sanjay Malhotra is the new governor of RBI. Okay, now this Urjit Patel committee, he suggested that the India should maintain a target of 4% of inflation with a tolerance band of plus or minus 2. So from 2% to 6%, we should try to maintain. At the on an average, it should be 4%. Okay, +2 or -2 we can handle. Okay, that's what he said. All right, that was the committee's suggestion. So based on this target set by this committee, the RBI has a monetary policy committee also inside it, a 6-member committee, 3 from RBI and 3 from the government appointed by government. So they are responsible for setting up interest rates, okay, interest rates, so that we achieve this inflation target, okay, so that we achieve this inflation target. So if it's above 6%, that means we are in a very critical economic condition. All right, so that is the suggestion basically, that okay, on an average we should be at 4%, ±2 is like tolerable. Okay, now if RBI fails to meet the inflation target for 3 consecutive quarters, what happens? It must be accountable to the government and immediately propose actions, what they can suggest, okay, immediately. All right, so this is a mechanism of the RBI in terms of controlling inflation. Okay, then we have policy responses. So based on inflation target, RBI will set some repo rate, reverse repo rate, cash reserve ratio, or statutory liquidity ratio. All this will be set by RBI, and government will see that if they can increase or reduce their spending, if they need to increase or decrease the taxes, if the supply side measures, for example, whether they should improve the infrastructure or not, or minimum support price can be managed or not, all this take place when a target is set. Okay, so to understand all this, we need to understand what is monetary policy. Okay, what is monetary policy of RBI? Okay, so RBI, as we know, is the central bank of our country who controls the supply of money and credit in our economy. Okay, who controls the supply and credit in our economy, so that we achieve price stability, we achieve employment, and we also see economic growth sustainably. Okay, so monetary policy refers to the actions or all the actions taken by RBI to control the supply of money and credit in an economy, so that we achieve macroeconomic objectives. All right, so RBI is the central banking authority who is responsible for bringing this monetary policy. So quickly, monetary policy are nothing but actions undertaken by Reserve Bank of India to control money supply in our economy. So to implement monetary supply, RBI uses certain things which are based on quantitative and qualitative measures. So RBI also has measures. Okay, measures means measurement tools. Okay, one is quantitative, one is qualitative. So we will understand in quantitative instruments used by RBI for monetary policy. Number 1 is repo rate. Okay, number 1 is repo rate. So what is repo rate? It is the rate at which RBI lends money to commercial banks. So RBI to commercial bank, that is repo rate. Okay, that is repo rate. All right, so it is for a short term period. Okay, so a rate, remember, rate of money by which RBI gives money to commercial banks, that is repo rate. So just in your notes you can write RBI to commercial bank repo rate. Okay, RBI to commercial bank repo rate. Fine. The next one is reverse repo rate. So opposite of repo rate, when commercial bank gives money to RBI, so ulta. Okay, just reverse the direction. All right, commercial banks to RBI, that is reverse repo rate. So you can make notes like that also, short notes as we sit here and discuss. Then RBI also uses this marginal standing facility. What is this facility? Rate at which banks can borrow overnight from RBI. Okay, when there is an emergency situation, banks sometimes needs cash or sometimes need money in an instant. Okay, so the rate at which banks can borrow overnight from RBI so that they have liquidity in their banks, that is called marginal standing facility. All right, marginal standing facility. Fine. Then you have bank rate. Bank rate is rate at which RBI lends to commercial banks without any collateral. Okay, without any collateral. Now, what is the difference between bank rate and repo rate? What is
long term and short term.
Okay, that is fine. But what is the difference? Bank rate and repo rate.
So there is no collateral in bank rate.
Yeah, I hope people can understand what is collateral, right? It's security, basically.
No, sir.
Collateral means a security, okay? A security. Meaning that even if, for example, when you take a loan, what happens? If your credit score is not good, what will the bank say? Oh, your credit score is not good, but we are willing to give you loan if you can mortgage your car or your land. That becomes a security, right? So security, those type of securities are called as collateral. Okay, so in case there is a damage, in case like you are not able to pay, they will take the car, they will take your house, they will take your land, okay, in place of that money. Fine. What happens when you buy car in EMI? If you don't pay EMI, what will happen? The car will be gone. Okay, the car will be gone. So the car itself is a collateral. Okay, during that. So collateral means security. So in reverse or in repo rate, we have collateral. Okay, so remember this. What collateral? That is called government securities. Okay, anyone knows what is government securities? Do you know what is a government security? Yeah.
So it's like a bond.
It's like a bond. Okay. Explain me further if you know.
So it has time limit to make the maturity.
Okay. Who is it issued by? Government securities?
So by the RBI
Is
and
it?
the bank as well. No,
Is it?
sir, by the government, sir.
Government securities are by governments. Okay. So why do they issue these government securities? The central or state governments. Why do they issue government securities?
So to control the money supply in the market according to situation.
For example, when a government builds public infrastructures or public projects, the government gives certain coupons. Okay, government gives certain coupons, right? Those because when investors, for example, a company is trying to build a flyover, let's just say in Guwahati, okay, what will happen? They'll give the tender, all right, they'll give the tender. Do you think government pays the money upfront at that time? No, right? It does not pay upfront. It gives us bond. It gives a coupon. Okay, what is that coupon? That is your government securities. That after completion or during the course of the project, we will pay you something. Okay, so it is like acting as a security against government. All right, fine. So that is government securities. So collateral. Government securities can also be further given to banks and all as a collateral. Okay, so those is repo rate. Okay, those are repo rate. Repo rate uses collateral. Bank rate does not use collateral. Okay, fine. The next quantitative measure is cash reserve ratio, CRR. It is the percentage. Okay, it is not a rate, it is a percentage of net demand and time liabilities. Net demand and time liabilities the banks must hold as reserves with RBI. Can anyone tell me what is net demand and time liabilities? we know it is a reserve, okay, that the banks have to keep it with RBI. But what is net demand and time liabilities?
Sir, মানুহে উইথড্ৰ
Huh?
মানুহে উইথড্ৰ কৰা টাইমত মানে যিটো বেংকে
For example, okay, for example, you keep your money in the bank, right? In your savings account, right? Right? You keep money in your savings account, for example. But do you know where the money is going? They're just showing you on the screen that you have 10,000, 20,000, 50,000, whatever. They're just showing you in the screen that, okay, you have deposited this much. But you don't feel it, no, you don't feel the cash in your hands, right? So yes, the banks are using that money for something else, okay? So it owes you money instead. You saved it, but they are using it for something else, okay? So it owes you money, okay? It owes you money. So now if you go to bank and say, okay, I deposited last month 10,000, can I take it back? The bank will never say, no, you cannot, right? It does not have the right to say like, no, you cannot take out. If they say like that, what will happen? You can file a case against the bank that he's just losing my money, okay? He's not giving me my money, okay? So that is one type of time deposit that bank keeps, okay? Time deposit and liabilities that banks keep, okay? Plus banks also deposit in other banks, right? Banks also deposit in other banks. So those are called net time liabilities or net time deposits and liabilities, okay? The banks, the money the banks owe to people, okay? To owe people and other banks, okay? So some reserve of that, whatever money bank is getting in their accounts, okay, whatever money you go to SBI, whatever SBI is getting from you, plus whatever deposits are being made, okay, inside SBI by other banks, they have to keep a percentage with RBI. From there, they have to keep a percentage with RBI. That percentage is called cash reserve ratio. That percentage is called cash reserve ratio. Understanding? Fine? Any confusion on
Yes,
this?
sir.
Fine? Okay.
Yes, sir.
The next one is statutory liquidity ratio. Now this is again a percentage of the same that deposits the NDTL, all this net demand and time liabilities, whatever deposits banks keep from other customers as well as other banks, they have to convert a percentage of that deposit. 1% will be saved with RBI, okay, which is called the reserve ratio, that is with RBI. Another percentage they have to maintain in liquid assets, means in form of cash, in form of gold, or in form of securities, okay? A percentage of that deposit has to be converted into liquid assets, that is called cash, gold, or securities. That is none other than statutory liquidity ratio. Fine? Understanding?
Sir, Areba বুজাই দিয়কচোন।
Statutory liquidity ratio means এটা percentage যোনটো বেংকে অলৰেডি মানে মানুহৰ পৰা ডেপোজিট লয় বা বেংকৰ পৰা ডেপোজিট লয়, যোনটো এটা পাৰ্চেণ্টেজ থাকে, এটা পাৰ্চেণ্টেজটো RBI লগত ৰিজাৰ্ভ থাকিব, that is cash reserve ratio, okay? They have to show to RBI that ইমানখিনি আমি আপোনাৰ লগত থৈছো, fine, that is cash reserve. Another percentage of the same deposits that it has gathered, okay, from customers and from other banks, it has to convert that percentage into cash, in gold, or in approved securities, okay? Securities means all those government securities or anything, okay? মানে সেই deposit amount to cashত নহলে gold priceত convert কৰিব লাগিব. You understanding? So they have to keep this statutory liquidity ratio. Why they have to keep it converted? Can anyone tell me the reason why? Why are they
Sir, emergency হলে
easy hoy
দিব
emergency
পাৰা
only? Yeah.
Hmm.
When there is cash crunch, they can use that ratio, all right? And some percentage is reserved with RBI because they can go to RBI later on, say we have finished our stock, please can we take out from your reserve? Okay, that is the reason. Okay, in simple terms, okay, in simple words. Fine, that was statutory liquidity ratio. The next one is called open market operations, OMOs. Okay, open market operations. What is it? It is either the buying or selling of government securities by RBI in the open market. When government securities are sold or bought by RBI, that is called open market operations. Okay, that is called open market operations. Fine, it's very simple. Open market operations means when RBI buys or sells government securities. Okay, government securities, that is called open market operations. Fine, this is easy. Sorry, not this document. Then there is market stabilization scheme. Market stabilization scheme, another measure of instrument. It is used to absorb excess liquidity. What is liquidity? When your money is in cash form, in gold form, or in securities form, all right? Used to absorb excess liquidity arising from large capital inflows by issuing short-dated government securities. So sometimes what happens is when there is a large capital inflow, means coming in, okay, large capital coming in because government is selling their securities left, right, and center. What happens is a lot of money is in the market, all right, a lot of money is in the market. So to reduce that, we use market stabilization scheme. If a lot of money also is in the market, it's not good. Okay, it's not good. If less money also is there, it is not good for the economy. So it has to hit the balance. It has to hit the balance. Okay, you understood this ratios? Okay, at least the definition you understood. Fine. Any question on this? Quickly, if any questions, if you have.
ৰেপো ৰেটটো বুজি পালো স্যাৰ কি যোনটো আৰবিআই ইন্টাৰেষ্টটো বনাইকে ৰাখে কিন্তু বেংক ৰেটটো কি স্যাৰ মানে যোনটো আৰবিআই লয় কি স্যাৰ
Bank rate is what? Can anyone explain it to Prince? Try. The rest of you just explain, try to explain what is bank rate to Prince. What is bank rate? I'm asking the rest of you. Bank rate? Forgot. Let's look here again. What is bank rate? At which RBI lends to commercial banks without collateral. Okay, without collateral. Repo rate at which RBI lends to commercial banks with collateral, particularly government securities. With collateral. Fine, Prince.
Yes, sir.
Okay.
So মানে repo rate to RBI lend করে না commercial bank
Yeah,
with
bank rate.
collateral মানে security লগত
Hi. Bank rate also is a
or
bank rate also is RBI lending to commercial banks without collateral. Okay.
okay sir.
Without collateral. Okay, without collateral. All right. So now one more information. Bank rate is aligned with MSF rate. So these two, if you get in the configure, for example, the MSF rate is 12%. The bank rate is 13%. True statement or not?
No sir.
They have to be equal. Okay, they're at the same price. All right, because it is equal. Okay, marginal standing facility is what? Rate at which banks can borrow, meaning RBI lends to commercial banks when it needs emergency money. That means without collateral. Okay, without collateral. All right, without collateral. Okay, so let's solve this question. Question number 14. Very easy question which came in 2024. What is meant by repo rate of RBI? So tell me the correct answer.
Sir C.
C.
See, everyone?
Yes, sir. C.
Yes sir C.
Okay.
C.
Good. So C is the correct answer. So you see, you got a direct question in 2024 regarding this concept. So in economy, you please continue to do this chapter, monetary policy, inflation. Okay, in present context also, it is very, very important. Now we'll understand what happens when monetary policy, like for example, what happens when repo rate is increased, what happens to the money supply in an economy? So I have given in the document also, impact on money supply when increase. When increase means when repo rate is increased. First of all, when repo rate is increased, what happens? So the money supply decreases. Why? Because banks borrow less and they will also give out to customers less loans. So when repo rate is increased, so when repo rate is, for example, 7%, banks borrow money from RBI and they give it to you, okay, you and I. And when it's at 12%, bank also will not borrow from RBI and they will also not give out loan to the customers. Okay, so what happens when repo rate is increased and how does it affect on inflation then? So when repo rate is increased, inflation decreases. Okay, inflation decreases because there is no money in the supply. Okay, customers are not getting loans, so why will they buy things, right? So repo rate, RBI uses repo rate to decrease inflation. Okay, repo rate is being used to decrease inflation. Okay, when they increase repo rate, that means there is huge inflation in the country, so they are planning to reduce inflation. Okay, fine, you understood this concept. Okay, similarly, what happens to reverse repo rate? If it's increased, what happens to the money supply? So if in here also, rate at which RBI borrows money from commercial bank, if it is increased, money supply decreases. Okay, money supply decreases as well as inflation decreases. Okay, inflation decreases. All right, fine. Why? Because bank will banks park funds with RBI. Banks will keep the money with RBI. RBI does not give money to you, no, directly, right? It uses banks. RBI only gives money to banks, not to people, no. So when banks keep their money with RBI, meaning what? They are keeping it for safety. Okay, so money supply decreases and inflation also decreases. So we can see a relation between money supply and inflation. So if money supply is increased, we can see an increase in inflation also. If money supply in the economy is decreased, inflation also decreases. All right. What happens when the rate at which banks can borrow overnight from RBI is increased? Again, same thing, money supply will decrease, banks will not have money. Okay, banks will not have money. All right, if it's increased, and then inflation also, inflation is decreased alongside money supply decrease. Okay, because marginal standing facility means banks at the rate at which banks can borrow overnight. So urgently, if a banks need money, then only they borrow this. But if the rate is high, why will bank borrow from RBI, right? And when banks don't borrow, what happens? People also don't get money. So money supply is again decreased. All right. What happens if the bank rate is increased? Same thing, decreases, decreases. Money supply decreases, inflation also decreases. What about cash reserve ratio? If cash reserve ratio is increased, money supply also decreases because less money is again available. Cash reserve means what? What was cash reserve?
Which is reserved in the RBI by commercial banks.
Yeah.
Commercial banks.
Yeah, so when banks reserve certain amount of money, let's just say with RBI, if it is increased, that reserve ratio is increased. So let's just say from 20%, RBI says from tomorrow you'll have to keep 40% of your money with us as reserve ratio. So what will happen? The bank will have less money, right? Out of 100, 40% they are keeping in the RBI. So only 60% they can use. Now when cash reserve ratio is decreased, for example, okay, don't give 40%, give only 5% with RBI. So they have 95% in their hand they can use. So cash reserve ratio, if it increases, money supply also decreases. Inflation also decreases. All right, fine. Then statutory liquidity ratio, if the ratio is again increased, money supply decreases, inflation decreases. Fine. Same thing, all the conditions are same in all the measures. All the conditions are same. If they are increased, money supply decreases, inflation also decreases. So we can say the quantitative measures of RBI, okay, the quantitative measures of RBI is inversely proportional to money supply and inflation. Is it true or not?
True.
Sir.
True. Okay, so please keep this statement also in your mind. They might write quantitative measures of RBI is directly proportional to money supply and inflation. Is it true?
False.
False. Okay, so please keep that in mind. Directly proportional means if RBI increases the repo rate, money supply also increases and inflation also increases. Is it true? No, right? Fine. So please be aware of that statement. When they increase the rates, when RBI increase all these rates, what happens is money supply decreases, and due to money supply decreases, you have lower inflation. Okay, lower inflation. So based on these things, RBI sometimes uses these tools to either increase the inflation or to reduce the inflation. So for example, let us give us a condition. For example, our inflation is at 7%. Okay, our inflation is at 7%. What will happen what will be the step taken by RBI in regards of repo rate?
They will increase it.
They will increase it.
Increase it.
Okay, they will increase it. Okay, what happens if our inflation is at 4%? On regards of reverse repo rate, what will RBI do?
They will maintain it.
Yeah, they will maintain it because our target of inflation is 4%. Very good. Okay, so similarly, this type of questions can be asked. Be very careful with this concept. Are you fine with this concept now? Okay, fine. So these were the quantitative measures. These are only important. Quantitative measures is very, very important. Okay, the rest we have qualitative instruments or qualitative measures of monetary policy used by RBI. All right, just understand margin requirements. Qualitative means what? Qualitative means quality of the measurement. Okay, quantitative means numbers, directly numbers. All right, so margin requirements means RBI prescribes a margin. Okay, a margin. What is that margin? Portion of loan value which is not financed by a bank for loans against certain securities. So the condition is increasing the margins reduces credit for speculative activities. Okay, fine. Margin requirement means that RBI is asking the bank, okay, a portion of a loan value, okay, portion of loan value for certain securities, okay, for certain securities. So they have to keep this portion to get some securities. When you increase the margin, it automatically reduces credit supply for, some people might just keep getting loans after loans, right? So the RBI might suddenly say, oh, this person is taking a lot of loans. Just we have to check whether there is something wrong with the bank or not, if the bank is giving a lot of bad loans or not. Okay, so margin requirement is that a margin, a portion of the loan value has to be kept. Okay, has to be kept. The second type is credit rationing. Credit rationing means fixing credit limits for certain sectors or purposes to control the flow of credit. Okay, for certain sectors, let's just say education sectors. Okay, the RBI might just say tomorrow that from tomorrow all the education sector institutes and all the businesses, they will keep this much credit limit. Beyond that they cannot give credit. Okay, beyond this limit they cannot give credit. So this kind of things RBI takes, okay, to control the flow of credit. All right, the third is moral suasion, which is advising the commercial banks that please follow the monetary policy, do not go beyond it. That is moral suasion. And the last is direct action, meaning direct penalties if they don't comply with RBI directives. For whom? For banks. So RBI can take strict actions against any bank if they don't comply or follow the RBI directives. All right, RBI directives. Fine. So these are your monetary policy tools or instruments for monetary policy. So what is monetary policy? Actions taken by central bank to control the supply of money and credit. So if you look in all the quantitative as well as qualitative, the purpose is the same: to control money supply and to stop or control credit flow. Okay, to control the credit flow. Any questions? Any question on this?
Sir, last तीनटा तो बुझारी पण किशोर.
Last or tinta? Which one? This three?
So yes, credit, moral, and direct action. All of that.
So for example, okay, this is qualitative instrument. Okay, qualitative instrument. The top ones were quantitative instruments of monetary policy. Now, Prince, tell me, what is the purpose of what is the purpose of monetary policy by RBI?
So to control the inflation.
To control the,
Inflation.
not inflation, to control money supply
Money supply.
in the economy. Then only inflation is controlled. Okay. So credit rationing means fixing a credit limit. For example, if you are a bank, okay, if you are a bank and I'm RBI, I can tell you that you please keep your credit limit of only 100. Okay, meaning beyond 100 you cannot give money to someone else. Okay, that is fixing credit limit. Now credit rationing means fixing a limit for certain sectors or purposes. For example, I'm telling the Bank of India that, oh, Bank of India, if you have to give education sector money, your limit is only 100. Okay, your limit is only 100. All right, if you give beyond 100, you'll be punished. That is credit rationing. All right, so fixing credit limits
So
for
like whoever have credit score more than 100, they can then on to the only person they can give the loan over. So
no, credit limit, don't think in terms of your individual credit score or something. Yes, credit score means what? Based on your credit score, you get certain amount of loan, right? Right. So that is also can be put as credit rationing, but this is in case of RBI to, banks against certain sectors. Sometimes banks also give a lot of investment or a lot of money loans to, education, agriculture, and all those schemes, right? So there is a fixed credit limit. Okay, RBI will fix credit limit for certain sectors and your purpose. Okay, so beyond that, the banks cannot give loan. So yes, like how you're saying, okay, what about our credit score and all? Yes, it is one way of credit rationing. You don't get more than your credit score, no. So that is also a credit rationing. Okay, you can say that. Okay, but this is especially for banks. Okay, RBI to banks regarding certain sectors. Okay, fine. The
so
second,
do the certain substance have to maintain the credit rationing, or the banks have to maintain the credit rationing? Like
the banks.
the banks have 100 credits, so they can give loans to the certain sections. Right.
Yeah, it's from the bank only. Like for example, if a education sector comes, education businesses come and say, like, to a bank that, oh sir, give me a loan of 110 crore. The bank will say, like, we have only limit of 100 crore. We can't give you beyond that. Now they will say, why? You have money, your bank. The bank will say, we are following RBI's directive of maintaining our credit rationing, so we cannot give you more than that. Okay, that is credit rationing. Okay. The next one was moral suasion. Moral suasion means what? RBI giving advice to commercial banks that please follow our policy, otherwise you will be punished. That is direct action. So when banks don't follow the policy, what happens? RBI will impose banks. A bank cannot go beyond the directives of RBI because RBI is the central bank of India. Okay, so it cannot go beyond the directives of RBI. So when a bank don't follow that, for example, when a bank don't follow credit rationing or the credit limit, they're giving 120, 140 to every sector. So the RBI can take actions against them by imposing penalties, and they will also refuse discount facilities or rediscount facilities to the banks. All right. So these are the purpose of monetary policy. These are some tools: repo rate based on quantitative. Then we have in qualitative, margin requirements, credit rationing, and all those. Okay, fine. So these are some things that you have to keep it in your mind for economy. Okay. All right. Okay. Then we come to the concept of money supply. What exactly is money supply? Can anyone tell me? What exactly is money supply?
So availability of money in markets.
Yeah, availability of money in market. All right. So money supply refers to the total stock of money that is in an economy, that is circulating in an economy. Okay. So you have 10 rupees as in your hand right now. So you want to buy a packet of chips. So you will give it to the shopkeeper. Okay. That same 10 rupees, the shopkeeper will give it to the wholesaler to buy more chips. Maybe he's getting two of the chips. The same wholesaler will give the 10 rupees to the company that is making the chips. Then from the companies, it is going to the farmers. Okay. And likewise, from the farmers, it is coming back into the circle again. The farmer's kid wants to buy the chip again. So it is circulating. So money supply is referring to the total stock of money. So it begins with a number. Okay. The stock always begins with a number. For example, if you have to start a business, let's just say a grocery store, what will you do? First, you will stock up the shop. You will buy things from wholesale market and you'll stock it up. Let's just say you have 10 pens. Okay, you have 10 pens and you sold 5 of them. You will see that the demand of pens are high, so you will restock it, right? You will restock it. How will you restock it? You'll buy again by the money that you get. Okay, so that means a money supply refers to the money circulating in an economy. Okay, circulating economy at a specific point of time. So today is 2026. So in 2026, what is our money supply? So basically, money supply is nothing but quantity of money in an area or in a specific point of time. What does it include? It includes currency held by the public, that is the money that you and I have in our pockets, in our bank accounts. Okay, various forms of deposits with commercial banks. Okay, and other financial institutes, like for example, you have deposited in fixed deposit, recurring deposit, mutual funds, stock exchange, whatever. That is all included in money supply. So money supply is a crucial determinant of economic activity. Okay, crucial determinant of economic activity, which can influence inflation, interest rates, and the growth of our country. Okay, growth of our country. So like I said, what are the components of money supply? We have the currency with public. So that means physical currency notes, coins, okay, even by individuals and businesses, okay, outside the banking system. All right, outside the banking system means, for example, in villages, not everyone has bank accounts, right? But they have money in their hands. So that also will be counted as currency with public. Remember this statement. Then demand deposits. These are deposits held by public in commercial banks, which can be withdrawn on demand. For example, current and savings balances, whatever businesses, individuals have as deposits. So these only are the two components of money supply. You might be asked a question, a statement type of question regarding this one. Like, does currency with public have include the money that is held by individuals and businesses outside of the banking system? Okay, so yes, even outside of the banking system, that money will be considered as a component of money supply. All right, fine. So money supply again is reserved. It is calculated or measured by RBI, Reserve Bank of India. So Reserve Bank of India has categorized money supply in our country as few categories. Okay, few categories. There is 0, MO, okay, M1, M2, and M3, M4. Okay, M1, M2 are called as narrow money. M3, M4 is called as broad money. So it is based on their liquidity. How fast can we make them liquid? Okay, that is based on their liquidity. All right. So which is the most liquid? M1 is the most liquid, and the least one is M4. Understanding this concept?
Yes, sir.
Okay.
Yes, sir.
You understood money supply? Okay, fine. So like I said, M money or M0 is the reserved money, okay, is the reserved money, all right, which is, what does it include? The currency that is in circulation, the deposits made by banks with RBI, and other deposits that are with RBI, okay. So whatever RBI has, it is the M0 money, that means the stock, okay, the stock. The first stock is with RBI, right? The first stock of money is with RBI. So that money can be called in when there is trouble. For example, the banks are facing liquidity problem. The banks do not have money. Where will they go? The banks. They will go to RBI. Okay, they will go to RBI. So that is why in liquidity assets, in liquidity case, it is the highest liquid money. Liquid means, what does liquid mean?
So easily convertible.
Easily convertible.
To cash.
Okay, easily convertible. Easily convertible. All right. Fine. That is the stock. This is the stock. This is where it begins, money supply. Where it begins with RBI. Okay, with RBI. Okay. So this is the monetary base from which the banking system creates money supply. Okay, this is the base. M0 is the base. All right, M0 is the base. This is directly controlled by RBI. Okay, this is directly controlled by RBI, so that any problem in the banking system, RBI comes and help. The second one, called M1 or a narrow money. See, M0 is reserve money, remember this, or high powered money. Okay, M1 is narrow money. So what is this narrow money? M1, it has all the currency with public, okay, all the currency with public, okay, in your pocket, okay, directly. Then the demand deposits, okay, then the demand deposits. What are the demand deposits? That you put in banks, okay, or in mutual funds, and any other deposits with RBI, okay, any other deposits with RBI. So what is the liquidity ratio? It is also high. It can be converted again. All right. So it represents money readily available for transactions. The first one was, it is the base. The first one was base. This is for transaction, available for transaction. So what is the purpose of this? A short-term economic analysis. It gives us a short-term economic analysis, meaning reflecting our purchasing power. M1 reflects our purchasing power. Okay. M2, again under narrow money, it is M1, all of this, whatever is we have mentioned, all of this plus saving deposits with post office. This is the difference. Okay, M1, all of M1 plus saving deposits with post office. So remember all this. Okay, remember all these statements. Well, what is M1, what is M2? It is very confusing. It can be asked. Okay, so this liquidity aspect is medium to high. Okay, so it includes less liquid saving deposits from post office, because from post office, if you know, if you save in post office, you cannot quickly withdraw like how we can withdraw from banks, right? It takes some time. Okay, it is not saying you cannot completely withdraw at all, but it takes some time from post office saving banks, if you have noticed. Okay, so that plus M1 is called M2 money. Okay, M2 money. So it shows us what? A wide range of short-term savings. So how much people are saving in short term, we get an idea. Broad money, M3. M1 plus net deposits of commercial banks. What is net time deposits?
Fixed.
Demand available as a cash.
No, net time deposits are fixed deposits or recurring deposits. Okay, net time deposits are fixed deposits or recurring deposits. Net time meaning you get this fixed deposit and recurring deposit after certain period of time, right? You don't get it immediately. Okay, it is not withdrawable on demand. You cannot say to a bank, oh, I want to break my fixed deposit, but the bank will say, sir, you have invested for 15 years, you cannot break it now, only after 15 years you'll get this, right? So that is nap time deposit. So time is there. Okay, so M3 means it is the aggregate monetary resources. Okay, aggregate monetary resources, and this is what most of the time it is used. M3 is used most commonly to measure money supply in the country, because most of us, or many of us, we have savings, right? We also have net time deposits in commercial banks. Okay, fine. So it is an indicator that captures both transaction as well as savings. Okay, so both transactions and savings are calculated under this. That is why it is mostly used. Fine, that is why it is a broad money. What is the liquidity aspect? Medium. M4, the other type of broad money, means M3 plus total deposits with post office savings. Okay, total deposits with post office savings organizations, but it excludes, excludes national savings certificates. Does anyone know what is national savings certificates?
Sir, এইটো 5 years মানৰ কাৰণে ডিপোজিট কৰিব পাৰি কেনেকুৱা ৰিটাৰ্ণ sir এইটো NSC কাটা বুলি কয় 5 years মান এনেকুৱা মান sir ডিপোজিট কৰিব পাৰি তেতিয়া ৰিটাৰ্ণ পায় আৰু
National, yeah, you're right. Okay, so this is including all types of deposits with banks and post offices. Okay, this includes all type of deposits with banks and post offices. Okay, so it is a very broad money, and it is not very liquid, not at all liquid, or very low liquidity. So you cannot get this money directly or on the spot, on demand. Okay, you cannot get this. Fine. Fine.
Yes, sir.
Okay, now I'll ask one of my best friend. Okay, I'll ask him to frame a few MCQ. Let's see if you can do or not. Three MCQs on money supply quickly, if you have understood this. So let's see. Rest, if you look in the analysis of your economy in 2024, we had one from this topic, repo rate. Okay, one from this topic. Rest are mostly associated with your current affairs. Okay, like what is CRR? We already have done. Okay, which of the following is not a fiscal instrument? You can answer it from here only. Which of them is not a fiscal instrument? Tell me. Question
CRR.
Right? So Harlongbi says CRR. The rest of you?
Sir, CRR.
CRR. Okay, CRR is what instrument?
RBI sir.
Huh?
Monetary.
Monetary.
Monetary instrument. Okay, monetary policy, not a fiscal instrument. Fiscal means what? Government. No? Government. Fiscal is government. So very easily you could solve from this here only. So two topics we got from that. Okay, two topics. Rest we have not reached. Some of them, like for example fiscal ability and all those, we have not reached as of now. Income tax, tax to GDP ratio. All right, fine. Solve question number 1 first. Which of the following correctly describes the components of money supply in Indian context?
Sir, D.
Okay.
Sir, A.
B.
So Harlongbi says D. Then
Sir, A.
Sorry.
Rushika Prince says A.
Yes.
Both the Prince says A. The rest of you, Mohan, Vidisha, and all those.
D.
Sir,
Sir,
A.
I said D.
Sir, A.
A. So majority of you are saying A. Let's see A. Okay, we have pressed A here. Okay, we'll see the answer in short while. Question number 2, solve now.
Sir, B.
B.
B, sir.
B.
Yes.
Okay.
B, sir. Bond.
Huh?
Sir, B. Bond.
Okay. The rest, I hope you're not Googling and all. Because
Sir,
it's-
B.
okay, so majority of you said B. Fine. All right. Question number 3. Consider the following statements regarding the determinants of money supply. So changes in composition of monetary base, reserve requirement, current deposit ratio. So this is the hardest question. So which one is your correct answer?
Sir, only 2.
Huh? Only 2.
Yes, sir, only 2.
The rest of you? Rest of you?
Sir, still trying to understand, sir.
Huh?
Still trying to understand, sir. It will take 1 more minute.
Okay.
Sir, only 2. Sir,
Hmm?
only 2.
The girls, at least one or two of you. So I'll consider most of you are saying only 2. So let's see. Someone got it wrong. Question number 1. Which of the following describes the components of money supply in Indian context? A statement is correct. M4 is not correct because it does not include national savings certificates. It excludes national savings certificates. From your notebook, from your notes itself, you'll come to know this. Okay, these are all, wrong, the other statements. Okay, fine. Question number 2, near money. The concept of near money means the things that are highly liquid, okay, highly liquidable assets which can be easily converted. This is called near money. There is also a concept called dear money. Okay, concept called dear money. Anyone knows what is dear money? I put it in chat. What is dear money? Concept called dear money. Have you heard of dear money?
No, sir.
Yes, sir.
What is dear money? I've given in the chat. Dear money refers to the money when RBI makes a tight monetary policy, meaning it is not easily available. Okay, it is not easily available in the market, right? Money is there with RBI, but it is not easily available in circulation. That is dear money. Okay, that is dear money. Then there is easy money or cheap money. What is easy or cheap money?
স্যাৰ
Yeah.
স্যাৰ মই ইউনিভাৰ্চিটি যাব লৈছিলোঁ স্যাৰ ক্লাছটো এইখিনিতে আহিব পাৰিমনে
Class to কি?
স্যাৰ মানে এইখিনিতে ক্লাছটো স্যাৰ লিভ কৰোঁ বুলি ভাবিছোঁ এতিয়া স্যাৰ আকৌ ইভিনিং ক্লাছটোত পাই যাম স্যাৰ
Okay, it's almost over today's class. Just give me this definition of easy money. What is easy money? Okay, what is easy money?
So it's available in the market.
Yeah, so these three concepts are there. Near money, which is highly liquid. Okay, easy money, always easily available in the market. When RBI makes a loose monetary policy, that is easy money or cheap money. Dear money means when RBI makes a tight monetary policy, that is dear money. All right.
Sure, tight monetary means contractionary policy.
Yes, contractionary policy. When all the bank rates increases, okay, repo rate, bank rates, reverse repo rate, all this when they increase by RBI, that is a tight monetary policy, right? So dear money means increasing of the rates of monetary instruments. Okay, easy money means loosening it. Okay, the money is in circulation. All right, fine. So three concepts, new concepts also we learn quickly: near, dear, and easy money. Okay, please keep this in your mind also. Fine. Okay, so we are still doing inflation because it is an important topic for your current affairs as well as what is going on as of now in the country. Okay, so please keep in touch with the current affairs news, like for example, regarding inflation. Yesterday I have given you in the telegram channel regarding producer price index. Please go through that again. All right, fine. So we will stop here.
Yes.
For today, please read the notes again and again and again. If you don't understand, please go through this M1, M2, M3, M4. Very, very important. Okay, very, very important. All right. So, all right, we'll see you for Assam base. Yesterday, some of you did not come.
Yes, sir. I fell asleep, sir.
Yeah, that will happen. So eat now, sleep for 1-2 hours, and be fresh and come back. Because we don't have time now. We only have like till how many days? You just got 10 days already. 20 days in your hand for prelims, APSC prelims. So as much as we can, we should revise. Okay, you can study on your own also, but then revision together helps you better. Okay, So please come for the classes because we are entering into medieval Assam, and medieval Assam is very, very important. Okay, it has a lot of kingdoms and dynasties. So anyways, we'll see you after 2 hours. Fine, 2-3 hours. Yeah.
Thank you, sir.
Thank you, sir.
All right.
Thank you, sir.